Hello, and thank you for joining our call today, which is being recorded on January the 3rd. Anastasia and Kate, are you both in New York?
Yes, we are.
Okay, so we'd like to thank you for braving the weather. I think you guys got dumped a pretty good amount of snow last night. So we were recording on the 3rd. We will be playing this on the 8th. My name is Keith Downey. I'm the managing director of Harvard Advisors in what is sunny Tulsa, Oklahoma. We have no snow on the ground, and we are the host of your call today. The call is going to be interactive discussion with our guest speaker, who I will introduce momentarily. The questions were compiled from our clients and prospective clients. We condensed a few together just to make the call flow a little better and try to keep this hopefully around 30 to 45 minutes to respect everyone's time. For those of you that are not familiar with Harvard Advisors, we have a slide up here. Here's our information. We're an independent full-service wealth management firm and financial planning firm. What we do is we assist our clients in various areas of their lives, including comprehensive financial planning, asset management and portfolio construction, risk management, and we do retirement plans for our business owner clients and key employees. One of the ways that we're able to offer so many services is that we leverage the resources and the services of our partners, such as JP Morgan, who is speaking on our call today. As part of our service to our clients, we try to do a few of these calls a year to be both educational and informative. You can visit our website to see the events page, and we'll also be posting this on our website after the 8th, so if you do miss the call, you can view it then. Today's topic is a review of 2013 and an outlook on what we think will happen in 2014. But before I get started, I'd like to take a second to thank Kimber Lacey with our firm and Katie Monroe, who is on the call with us today from JP Morgan, who frankly did all the heavy lifting putting this together. So I'd like to thank both of them. We do have some slides on here from JP Morgan, their guide to the market, which was literally published yesterday. So bear with us a little bit. We did get to condense it down to the slides we want, but they're not in the exact order, so we'll be scrolling around a little bit, so bear with us. And with that, I'm going to introduce Anastasia Amoroso, who is a Vice President and Global Market Strategist with JP Morgan. We're very pleased to have her on the call today, and thank you for taking time out. I know she's very busy, so thank you, Anastasia, for being on the call.
Thank you very much, Keith. Looking forward to it.
All right. Okay, so I think we'll start off with the easy one, which if you could do a little bit of a summary of 2013, it was kind of an interesting year, how some of the asset classes performed relative to how the U.S. equity market did, which obviously had a great year. So if you would just spend a little time and talk about 2013 and what you saw and what happened and summarize that a bit.
Yes, absolutely. So you're absolutely right. 2013 has been a phenomenal year for risk assets, specifically for U.S. equities, and we'll go through some of the performance numbers here in a little bit. But I want to start off by talking about why is it that it ended up being quite a phenomenal year. Because going into the beginning of 2013, recall what the biggest risk was. And, of course, it was the sequester, it was the fiscal cliff, and are we going to be able to withstand Washington? That was the question that we were asking ourselves as consumers and as investors. Because, as you know, on December 31st, or in the early hours of January 1st of 2012-2013, that's when Congress finally agreed to extend most of the Bush tax cuts and to still go forward with the sequester, raise the payroll tax. So some of those things were going to have an impact, of course, on consumer finances and consumer fundamentals. So as we went through the year, though, it became evident that the payroll tax rising by 2% was not a deterrent to spending at all, and retail sales actually continued on pace with record levels. So that was one thing. The second thing, of course, the biggest the biggest question of the year was the Fed tapering, meaning when will the Fed reduce the pace of asset purchases that's been keeping a lid on long-term rates, and presumably that's what's been driving the U.S. economy. So as it turned out, in December of 2013 is when the Fed finally announced that they will reduce the pace of purchases starting on January 1st. So why does that mean, and why did the market previously reacted so negatively, for example, in the middle of the year, in June specifically? So, Well, we have been accustomed to an era of easy monetary policy, but with that era of easy, unprecedented monetary policy winding down, investors were questioning, will the economy continue to be on track? This is why the market rallied through the second half of the year, is because the Fed made it clear that two conditions have to be satisfied for them to reduce the pace of purchases. And those conditions are a substantial and self-sustained improvement in the U.S. economy. So when the Fed announced on December 18th that they will in fact start reducing the pace of purchases, that is because those two conditions have been satisfied. So that is very good for the economy and consequently very good for the market. So let me now turn to page 39 and go a little bit through the actual performance of the equity markets. So on slide 39 there, that should be in front of you, if you focus first of all on the left-hand part of the page, we show the actual performance numbers. So for example, the S&P 500 here in the United States was up 32.4% for 2013, and that includes price return and dividend return, so total return. Then you go to the developed markets, the EFA index, it's up 23.3%. Pacific ex-Japan, on the other hand, is up 5.6%. And then we come to emerging markets that are actually down 2.3%. So this really shows us that this has been a tale of two cities, a tale of two returns here for the world equities, with the U.S. markets outpacing some of the international markets. But not all. I will point out that Japan, in local terms, there towards the middle of the second part of this table, Japan is up 34.8% for 2013, although when you convert that to U.S. dollars, that is a 27.3% return. Germany is up 32%. So some markets in the U.S. and in the developed market economies have performed well, but not so much the case for India, Brazil, and Russia. Then you can see there towards the bottom. So why is that? The answer, part of the answer at least, lies on the right-hand side of the page, where we break down the sources of global equity returns into really three parts. First of all, we show earnings. Because when we invest in the stock market is because we invest in the future earnings of the companies that we invest in. And what you've seen is that we had a lot of earnings growth in the United States, but actually a lot more in Japan, and you can see that in the blue earnings portion. But the reason why the U.S. equity markets rallied as much as they did is because how much investors are willing to pay up for that share of earnings, that number is actually expanded. So this is something we call the multiple. So a lot of the U.S. equity market returns materialized because of the multiple expansion, which happened because consumers started to believe once again in the U.S. economy. So that's the case for the United States, that's the case for Europe, it's the case for Japan and UK, but that is not the case for, or has not been the case in 2013 for emerging markets, where earnings have actually been negative, confidence has been sapped, and it's only the dividends that contributed positively to the equity markets. So that's on the equity market side. And just quickly to talk about fixed income, it's been a somewhat challenging year for fixed income because, of course, the 10-year yield went from 1.6% in May to just about 3% by the end of the year. So as a result of that, the aggregate bond market has suffered a decline of about 2% in total return terms, although there absolutely have been pockets of strength, whether it's U.S. high yield, whether it's international high yield, whether it's even Spanish bonds that are up 15.5% for the year. Let me pause and see if there are follow-up questions to that.
No, you're doing great so far. It's going to lead a little bit into making some notes so we can capitalize when we get into the 2014 part, but that's fantastic.
Yeah. So that's really what's been happening in 2013, but perhaps we can segue into opportunities in 2014.
Exactly. So the probably the most popular question we got is, of course, everybody wants to know where you think the markets are going in 2014, just generally speaking, and then we got a lot of questions beyond that, drilling a little more specifically into some issues. But what are the opportunities as you see them in 2014?
So we think equities do continue to move higher. I don't think we can expect another 30% year, but we think equities do continue to move high. So there are a couple of reasons for that. So first of all, let me take us through page 10. And on page 10, we do something similar to what we just looked at, and that is sources of total return. So we looked at multiples, earnings, and dividends. But this is actually looking at a data series going back to 1995. So let's walk through the last few year-over-year returns for, year-over-year returns for the S&P 500. And if you look all the way to the right-hand side, you'll notice that the gray part of these bars, which represents multiples, improving forward PE ratios, that has been the largest driver of return. Earnings is the green bar. That's also been a driver of return. And then, of course, dividends is the last component. But if you look, for example, at the end of the last business cycle, let's say 2005, 2006, 2007, you'll notice that most of the earnings growth actually comes just from earnings, not necessarily from multiples. So when we think about what drives the market higher, it's really two things. It's earnings and how much we're willing to pay up for those earnings. So what we expect to happen in 2014 is to get some of both, but not so much of multiple expansion as we've got in 2013. So one other way to kind of bring it all together is to look at page 11, for example. And on page 11, we're looking at confidence, earnings, and multiples. So we're looking at both parts of this equation. So first of all, in the bottom left, we're looking at the S&P 500 forward price to earnings ratio, how much we're willing to pay up for this share of earnings. And that multiple today is at 15.4 times, which is slightly above the average of 14.9 times, but it's certainly not anywhere close to 24 times that we've seen in 2000. So the point here is that the markets are not cheap, to be sure, but they're also not expensive. And we think that this multiple continues to move higher. One of the reasons why is actually in the top half of the page, where we plot this forward PE ratio next to consumer sentiment. And what you find is that the correlation between the two series has been quite pronounced, especially in recent years. As the gray line, the consumer sentiment, continued to move higher, so did forward PE. So we expect consumer sentiment to recover further in 2014. We can talk about some of the reasons and forward multiples to follow. Last but not least, in the bottom right-hand side of this page, we show earnings estimates. And as of the fourth quarter of 2013, we're on pace to 120 in forward earnings, and you multiply that by the PE ratio, and we could certainly get further upside from the current levels on the S&P. So that's kind of from the fundamental standpoint, but we can talk more about what drives consumer confidence or some of the other sectors.
Excellent. So, you mentioned that we needed, and when I talked to my colleagues, one of our biggest concerns is that, earnings growth, did slow down from the pace. Obviously, it was growing in 9 and 10. What really needs to happen to make the economy really start to expand and job growth increase?
Right. Yeah, that is a very key question, and the answer is twofold. We think there's two things that need to happen. First of all, the demand side of the equation needs to pick up, and this is why I keep talking about consumer confidence. The second thing that needs to happen is the supply of credit that actually enables consumers to go out and buy houses, go out and buy cars, and businesses to borrow. That supply of credit needs to expand as well. So let me take you through a couple of slides that can help us with that. So first of all, on slide number 28, we take a look at consumer confidence. And this chart goes back to 1972. And if we look at the average consumer confidence reading provided by the University of Michigan series, the average reading is 85. Where we are today is just in line with the average. But look at how depressed consumer confidence has been since this recovery began in 2009. We're certainly not anywhere close to where we normally are in a recovery and an expansion mode of the economy, which we are in an expansion mode in the economy. So if you look at prior consumer confidence readings in 2004 and 2007, we're not even back to those levels. But why is it that consumer confidence recovers? Well, we find that there are really four things that drive consumer confidence, and they're summarized in that box there in the top of the chart. There are really four things: gas prices, home prices, stock prices, and the unemployment rate. If all of those things move in their respective right direction, consumer confidence picks up. So if gas prices perhaps stay stable, maybe increase a little bit, if home prices continue to pick up, if the S&P, which already has been supportive to household net worth, continues to provide that support, and if the labor market improves, naturally the U.S. consumer feels confident. So this is why another tailwind that we've had in 2013 for retail sales, for example, has been the recovery in consumer confidence. Consumers had all of the reasons to be optimistic. So what does it have to do with the economy? What does it have to do with the markets? Well, this means two things. Recovering consumer confidence means two things. If we're feeling more optimistic about the U.S. economy, we're willing to spend money on goods and services. And consumption drives 70% of the U.S. GDP. So if consumers, if corporations are willing and able to put that cash to work, that is absolutely the recipe for a more robust recovery. And cyclical indicators have room to run. And if that's the case, that drives earnings growth. So one other slide I will point to here is slide 19. These are some of the credit-sensitive cyclical indicators that propel growth in this part of the cycle. They could be car sales, light vehicle sales, housing starts, real capital goods orders. So, for example, car sales are just now back to the average levels. We're just above the average levels, but they're not in their 2002 or 2006 highs. And the average age of a car in the United States is still about 11 years old. So we've got to replace those clunkers at some point. So that's one thing. The second thing, the housing starts. We have not built nearly enough homes to keep up with population growth. The average number of homes that we've built is about 1.3. In the last 4 to 5 years, we've just picked up the pace from 500,000 new home starts to about 1 million today. So there is more to that trend as well. And you can imagine the capital-intensive, the labor-intensive proposition that it is to build a house. So that provides stimulus to growth. Think about all the building materials that go into building a house. Think about all the labor that is involved. How many subcontractors might you need? How many closing agents might you need? So this is a huge economic stimulus. And last but not least, if corporations are also more confident because of a more confident consumer, they're willing to pay to put their cash back to work. And this is why the real capital goods orders, that's a fancy name for capital expenditures by corporations, expanding plants, building new operations, retooling their networks. Once again, that is a capital and labor-intensive proposition that drives economic growth. So consumer confidence is one key ingredient. If that happens, cyclical indicators rebound, which drives earnings growth. The second thing is, I mentioned that these are credit-sensitive indicators because most people need that car loan, most people need that mortgage loan in order to buy the house and buy the car. So we have to have the banking sector that is also willing and able to act. So I may be answering one of the other questions that you have, but let me see if there's a specific question that you might have on the banking sector.
Well, actually, yeah, we were leading a little bit ahead, but that's quite all right. What concerns do we have about the banking center? I know we didn't really forward any questions relative to legislation on the banking side, but obviously banks have been a target for some litigation recently, and not all of Dodd-Frank has been implemented. I mean, what do we see? Are there roadblocks on the banking side? What is going to make banks start to lend more? What's going to open that credit up? I know we have a lot of business owner clients that see in the real world that, as you mentioned earlier, credit is tighter, and them being able to borrow and finance is not what it was 5-6 years ago. So yes, if you could speak to that a little bit, that'd be great.
Yeah, well, you're absolutely right about that. It's not like it was back in 2007, and perhaps that is a good thing. But there's a couple of things that need to happen to make the banking sector that is once again providing support to the economy. Because to be sure, we have to have a healthy, a well-functioning banking sector to enable the credit creation, because that's what ultimately drives economic growth. But those two conditions are, first of all, banks need to be able to lend, meaning they have to be resilient enough to lend even in the most severe adverse case scenario circumstances, which I'll go through in a moment. The second thing is banks need to be willing to lend. So the first one, to answer the first question, I'll take us to page 34. And on page 34, there's something that you see there in the bottom right that's called common equity as percent of total assets. So we talked about bank regulation, and it's absolutely true that the Fed, the SEC, the Congress are requiring banks to hold more capital against their assets. And as they do so, they become more resilient. So if you look at the ratio of common equity to total assets, that ratio today is 11.1%, which is well above the average, and it is well above 2007, and is as high as it's been going back to 1934. So what this tells us is that the banks have satisfied their regulatory thresholds. They have become more resilient against an adverse severe case scenario. Because essentially what this ratio does is every year the Fed does these stress tests where they say, what if the stock market plummeted by 50%? What if the housing market declined by 24%, give or take? Of course, the economy is in recession. What would happen to the banking sector? So because the banks have now set aside enough capital buffer, they are much more resilient to withstand those severe adverse case scenario. What this tells us is that even if that scenario was played out, this is not what we expect, it's just a stress test, but even if that scenario were to unfold, banks should still be in a viable shape, which is absolutely key, because if you're going to provide credit to the economy, you have to make sure that the business model is intact. So that's one part of the equation. The second part is banks have to be willing to lend. And have the banks been willing to lend? The answer is probably not so much, but that has to do with a couple of reasons. First of all, the delinquency rates, and second of all, the profitability of lending. So first of all, if you look in the top left part of the page, you see there are lending standards for approved mortgage loans. And the lending standards, to capture that, we look at the average FICO score. So the average FICO score based on the mortgages originated as of November 2013 is 737. This is as high as we've seen it going back to 2000. So when we talk about the availability of credit and banks not willing to lend, this is most likely what's being referenced. And of course, the lending standards have tightened. But two things need to happen to reverse that. Delinquency rates need to fall, and rates need to rise on the long end to make banks more willing to lend. We actually have two of those conditions satisfied. First of all, if you look at the delinquency rate over to the right, we look at consumer loans, for example, commercial and industrial loans delinquency rates, and they are as low as they have been, 2.4% and 1% respectively. And actually, they're as low as we have this series going back to 1992. But if you look at the orange line there, which represents residential mortgages, the delinquency rate there is still 9.6%. So it is still elevated. But this time last quarter, it was 9.3%. So the delinquency rates are starting to fall. Banks are becoming more optimistic on collecting that mortgage payment, and as a result, they're actually becoming more optimistic about easing their lending standards, which is now ongoing. So that's one part of the equation. The other part, of course, is the profitability of lending. A steeper yield curve that we've witnessed in 2013, meaning that the short end, the short-term interest rates are still well anchored at 0 to 25 basis points, but the long end interest rates, let's say 10 years, started to rise. That boosts the bank profitability because, for example, a 30-year fixed-rate mortgage has everything to do with a 10-year treasury yield. So if the rate on a 30-year fixed rate mortgage is 4.4%, but it was 3.3%, that is, of course, a more profitable proposition for a bank, and as a result of that, lending should pick up. So if everything I'm saying is true, and if the thesis holds true, then one should reason that the number of mortgages that have been originated in the second and third quarter of last year, the number of new mortgage originations have picked up. So that is indeed what happened. And if we look in the lower bottom part of the page, we show mortgage originations, not the applications for mortgages, but how many new loans the banks have actually underwritten. So what you notice is that since about 2010, but even more so since about 2012, the number of new mortgages originated have rebounded quite a bit. In fact, since the bottom, it is up 77%. So slowly but surely, banks are becoming more willing to provide credit to the economy, which is absolutely key to a faster, better unfolding recovery.
So that sounds like, from a macro standpoint, we're kind of seeing that pick up. We did have another question about the possibility of failures and collapses like we had in 07 and 08. So from a general standpoint, it sounds like the balance sheets look better. Is there a fear that with additional legislation, if that were to come, or is there any fear of any collapses like we had back in 7 and 8?
We really do see the banking sector as much improved, and that is what the regulation is aimed at. It is to, of course, to prevent excessive risk-taking that that led to the collapse that we've seen in 2007, and the regulation is aimed at making the banks more resilient, because the regulators understand very well that you can't have a well-functioning economy without a well-functioning banking sector. So as a result of that, regulation has to focus, and it has focused on making sure banks are resilient, and that's exactly how we see the banking sector today. So I certainly would classify today's shape of both the corporate sector and the banking sector as much improved, and not anywhere close to 2007 issues that we've had.
Okay. Well, you mentioned consumer confidence in the banking sector being improved. Of course, on a regular basis, we get a lot of questions about political and international issues. There's been a topic recently about health care that's made a little bit of news. So we had several inquiries into is there a way to quantify the impact of the Affordable Care Act on the economy? Do you have an opinion on job growth or loss from that, what the cost is ultimately going to be to the individual, understanding that I'm not sure anybody really can measure the impact of what the health care bill is going to do?
Yeah, that is a great question, and certainly a timely one. And I think when we ask about what is the cost, most people are concerned about small businesses, or to be sure, businesses with 50-plus employees that are now subject to health care coverage, where they have to provide coverage to their employees. Most people are concerned that these employers will actually let go of the people or will reduce the hours below the 30-hour threshold. So while that may be true, we think there's some big mitigating circumstances there. And if we look at firms that have 50 to, let's say, 199 workers, what we find is that 91% of those firms are already offering coverage to their employees. So it's only 9% of that segment of all the businesses in the United States that are actually now subject to providing that expanded health care coverage. So even if the 9% of those firms did reduce their full-time or part-time workers, that wouldn't have a tremendous economic impact. So the bottom line is most firms in the United States, whether it's from 50 to 200 or 200 plus, all of those firms already have nearly universal coverage for their employees. So we don't think that's really the concern. The concern that we do have is exactly what you mentioned as the second part of your question, is what is going to happen with a cost of health care for an individual. And when we think about what the Affordable Care Act was meant to accomplish, it's probably two things. First of all, is to provide universal coverage. But second of all, address the cost of health care in the United States, the rising cost of health care, which is also above any other developed market country. So to us, so far, what this law has done is, yes, it made a big step forward towards providing universal coverage, but it has not addressed the cost, and in fact, it might actually drive up the cost in its current form. So the reason why I say the universal coverage, there's been huge strides that have been made, because now individuals have many ways to access healthcare, whether they buy it on a state exchange, whether they buy it on a federal healthcare.gov exchange and receive a subsidy, whether they're now covered by an expanded Medicaid program, whether they go to a private exchange, or whether they receive expanded healthcare coverage from the employer. So there are many other avenues that 35 million individuals that are uninsured that will be able to get that insurance coverage. So that is absolutely a step forward. But when we think about the cost issue of this, let's think about what happens with this universal coverage and what some of the problems are. First of all, not all states decided to introduce state exchanges. Actually, about half of the states decided not to introduce healthcare exchanges. So as a result of that, the federal government, the healthcare.gov website, will be responsible to providing those exchanges and to providing the subsidy. The second thing that might be happening is that companies could be dumping some employees onto the healthcare exchanges, whether it's private or whether it's public. So that could be one thing. The third thing is, think about who is most likely to sign up for this coverage. Is it somebody who is healthy, or is it somebody who thinks they might need coverage? It's likely the latter. So if you have people with pre-existing conditions, or if you have people who want that coverage sooner rather than later, because they have some issues that need to be covered, signing up, but the healthy that don't, that is not how the insurance industry works. So this is why we think the healthcare premiums could actually continue to rise unless we address the underlying issue of this, which is actually the quality of care, which is the value-based quality of care, not the pay-per-click, but rather providing a quality care, one type of fee, and holding the healthcare system accountable to providing that level of healthcare. So, a long-winded answer, but we think the universal coverage is well on its way. It will take some time. The cost issue is likely not yet addressed.
Okay. On a global perspective, we had a question about the level of debt worldwide, not just in Greece, Spain, and Ireland, which I did cheat and read your 2014 outlook from J.P. Morgan, and I saw some of the opinion there, but also in the United States as well. Still concerns, even though and you can get to the sequester a little bit in the United States as well, as to what effect that had. So the debt situation has improved some, but there's still a perception among a lot of people that debt is out of control. And the question is, one, what needs to happen to get it under control, and what are the ramifications if it doesn't?
Yeah, absolutely. I think the best way to answer that question is to look at page 22. And what we see on page 22 is the cause of the debt issue that we have in the United States and some of the ways to actually solve that. So first of all, what is debt? Why is it that in the bottom right hand of the page we show federal net debt as percent of GDP, and that percent is 72.8%, as high as we've seen it, well, at least going back to 1975. So why is it? Well, that is because for the last number of years, our federal government has been running a deficit, meaning spending more than they were taking in taxes, and the remainder had to be borrowed. So let me give you an example. If you look at the 2013 federal budget, and this is on the left-hand side of the page, the total spending for 2013 was $3.5 trillion. And that was comprised of several different categories. About half of that is what we call mandatory spending through Social Security, Medicare, and Medicaid. This is not appropriated by Congress every single year. This is mandatory. Then the rest of that falls into the discretionary category. And there's a defense discretionary, there's a non-defense discretionary. So defense comprises 22% of spending, non-defense discretionary comprises 13% of spending. But all in all, you combine all of the colors here, and it's $3.5 trillion. So of course we have to finance that somehow. And if we look at the composition of sources of financing, about 40% of government receipts come from income taxes, another 8% from corporate taxes, and 28% from payroll and other social insurance taxes. So $3.5 trillion minus all of these tax receipts does not quite equate to one another. So what happens is there is a gap. There's a gap of about $642 billion. That is how much in 2013 the United States Treasury had to borrow. That is how much Treasury issuance had to happen in order to maintain the spending level of $3.5 trillion. So there's actually some very good news on this front. In 2013, this was the first year since 2008 that the budget deficit was below $1 trillion. This was the first year since 2008. So it is true that we still have not reduced this gap, but we have reduced it quite a bit. So one way to look at that is in the top right hand of the page. And now we're looking at this borrowing gap, this budget deficit, in percent of GDP terms, just for standardization's sake. But if you look at the high bar in 2008, the government was running a 10% budget deficit as percent of GDP. You fast forward to today, in 2013, it was down to still a deficit, but a deficit of only 4.1%. You look at the forecast on the right-hand side, by 2015, we're looking at a deficit of only 2%. So if economic growth picks up and our budget deficit stays around 2%, we can actually reduce the debt burden that has been accumulated, which is exactly what you see in the chart below. You see that from 2013 through about 2018, you start to see that gray line decline. And it picks up once again from 2018, 2019 through 2023. So why is that? Why does it pick up in the outer years? Well, that's because two things happen. First of all, interest rate costs go higher. But second of all, healthcare costs go higher. Social Security and Medicare once again drive costs. And these are not J.P. Morgan estimates, by the way. These are congressional budget estimates. And that takes into account the impact of the Affordable Care Act. So the good news is that we have fixed the short-term trajectory, because what's the trouble with running a 6 or 7% budget deficit? Well, the trouble is that's what Spain and Greece was also running, and we know what happened there. So we fixed the short-term issue. We fixed the short-term trajectory. We've actually tackled the easy parts of this, because how do we bring down this deficit? Well, we've capped our non-defense discretionary spending. We've cut the non-defense discretionary spending, and we also cut our defense spending. And on the flip side, we also raised some taxes, whether it's the payroll tax, whether it's the taxes on high-income earners. All in all, that helped the government raise about $240 billion. So that's how we've reduced the gap. But going forward, it's tougher to address issues that will need to be addressed. Social Security and Medicare and Medicaid is certainly one of those things. So a little bit of good news, bad news here, but for the next foreseeable future, I think we've made a lot of material progress.
And Europe, although not lighting on fire, looks significantly better than it did 3 or 4 years ago as well.
Yeah, the challenge with Europe is that growth has been slow, and the trimming of budget deficits has also been slow. So as a result of that, the debt levels are still elevated. But at very least, what's positive for Europe is they have significantly reduced the budget deficit from a level of 6% in Spain to about 4.5% now. In Italy, from 6% to to closer to 3%. So there has been a lot of progress made there, because the first thing you need to do is address the budget deficit before the debt trajectory starts to decline. But yes, some progress there. A little bit slower on the front.
Okay. We have a couple of, got a few more to go, and then we'll try to wrap this up to keep it around 45 minutes, 50 minutes or so. But the last big topic, for the most part, is around interest rates and the bond market. Of course, everybody is always interested in what the Fed's going to do. We clearly had a big rate move in the 10-year Treasury around May and June of this year. What is the outlook on the interest rate front? We get a lot of emails about people watching the talking heads on TV, and they hear the bond market's horrible and get out and those types of things. So what's the outlook for rates for 2014, and when do we see the next big move happening?
Yeah. So first of all, let me start off by saying the bond market is not horrible, and there are places of strength even though the broad bond market is down 2%. So why is it that the bond market actually sold off in 2013? Well, because the Fed started to reduce accommodation in the 10-year, in the 5, 7, 10-year, 30-year sector of the bond market. So as they start to reduce the pace of purchases, yields rise as a function of faster economic growth. So we have to separate two things. We have to separate the short-term rates from that longer-term outlook. The short-term rates are expected to stay low till at least 2015, maybe 2016. So we've got another window of a year, year and a half, maybe even 2 years before the Fed starts hiking interest rates on the short term of things. The long term, the 10-year Treasury, for example, is impacted by faster economic growth in the absence of the Fed purchasing program. We actually think that the bulk of the adjustment in the 10-year has likely been achieved. The 10-year yield moved from 1.6% to 3%. And even with faster economic growth, it could stabilize somewhere in the neighborhood of 3.5% or 4.2%. So what we think is going to happen this year is that the lightning speed and the degree of the adjustment that we had in 2013 is likely to abate in 2014. So even as the long-term rates continue to grind higher, it's not going to be the same speed of the adjustment. So that said, what does that mean for fixed income investors? Should you absolutely shun fixed income? Well, no, absolutely not. But we absolutely do think that this is the time to think a little bit differently about fixed income, because it used to be that you need an allocation to fixed income so that you have essentially crash protection against a global economic collapse. And in the absence of that collapse, and in fact in the presence of a faster economic growth, you need something different. You need a new anchor in the portfolio that has low correlation with interest rates, that doesn't really move up or down, that's not impacted by rising interest rates, that derives its return from somewhere else. And the second thing you need is, of course, yield, but also optionality on this faster economic growth. You need sectors that benefit from rising interest rates, from better corporate fundamentals, better economic fundamentals, and better equity prices. So on slide 31, we actually highlight some of those sectors. So for example, floating rate, high yield, convertible bonds, and asset-backed securities, you'll see in red there, they have a negative correlation to a 10-year Treasury. So just because the 10-year yield moved higher and the price of a 10-year Treasury sold off, that actually means quite the opposite for high-yield floating rate convertible bonds and asset-backed securities. And if we look over all the way to the right in the right-hand column, if we look at the returns for 2013, those are the sectors that produce positive returns. 7.4% for high yield, 2.4% for floating rate, 24% for convertible bonds, and a little bit 0.14% for asset-backed securities. So my point is, we have to redefine our approach to fixed income, and we have to push the boundaries and look for these sectors that benefit from faster economic growth, four of which I've highlighted.
Excellent. In the municipal market, we've had Detroit, and of course Puerto Rico has a myriad of issues that we could probably have an 8-hour call about. But on the muni side, for our higher net worth clients, what do you see the impact of Detroit and Puerto Rico? Is it, from a default standpoint, is there concerns about the muni market in general going forward?
So I would say there's, at any given point in time, there's three concerns for the municipal market. First of all, it's the default risk. Of course, we became very acutely aware of with the presence of Detroit. The second one is interest rate risk as economic growth speeds up, and the third one is inflation risk. So in order to have a appropriate municipal bond portfolio, you have to have an approach that guards against most of those risks. So the good news is that despite Detroit, despite the rising rates, there are ways to mitigate the impact of those risks on your portfolio. So overall, we think the health of municipalities, broadly speaking, is improving, because as the labor markets recover, as retail sales speed up, as the real estate markets recover, that should bode well for the receipts of states and municipalities. So that should improve the financial picture broadly. But even if you do have other Detroits and other Puerto Ricos, active management, looking at the exact credits and identifying the risks and opportunities can help mitigate that risk, and of course, portfolio diversification. As far as interest rate risk and inflation risk goes, once again, there are ways to guard against those by shortening the duration, the maturity of the municipal bond portfolio, and perhaps having instruments within those portfolios that benefit from unexpected inflation. So last but not least, I will say this. Investors do still need municipal bonds. And in fact, municipal bond yields are quite attractive on a taxable equivalent basis. When deciding whether to purchase a 10-year muni bond, for example, or a 10-year treasury, the equation is really skewed towards purchasing a 10-year muni yield, provided the certain tax bracket. And of course, each individual, with your help, should determine whether that's the best course of action or not. But broadly speaking, if you look on page 36, and if you look at the taxable equivalent municipal yield, which is portrayed in the left-hand side of the page in blue, that taxable equivalent yield is well above the 10-year treasury, which is the line that you see there in gray. So municipal bonds are still attractive from this comparison.
Excellent. Okay, two other quick ones. I think we'll be able to wrap this up. What do you think the next bubble is?
The next bubble.
Everybody knows that one, right?
Yeah, of course. We all have a crystal ball, and here we go, the bubble ball. But the next area that we would be closely watching is China, because we've talked about the debt levels in the United States. We've talked about the trajectory there. We've talked about the debt burdens in Europe. But China is the one that had the largest surge of credit growth out of those three areas. And some of the credit growth perhaps occurred in a higher risk areas. So what we'll be really carefully watching this year and in the years that follow is the non-performing loans, for example, for Chinese banks, and whether those debt levels are becoming crippling and whether they're resulting in default levels that sooner or later need to be addressed with. Because when you look at China, it's not just the government debt level that we need to look at, because that's really not a concern. The debt levels from the government perspective, from the state government perspective, is really quite low. But it is when you add in all of the local government debt issued by the many provinces in China, it's when you combine that with some of the corporate issuance that's occurred, that's when you start to get to debt to GDP ratios that are really getting to be quite high. So it doesn't need to be a bubble and a burst, but it is something that we would be watching very carefully.
Okay. And then the last question we got was your opinion on real estate and where we are in the recovery.
Yeah. The residential recovery has absolutely been the growth driver for the economy in 2013. And it's interesting because if we look at the composition of GDP, we know that 70% of GDP growth is driven by consumer, and then residential construction adds about 3 percentage points. But that's a little bit misleading because even though residential structures may add 3% to the equation, it's the economic stimulus that comes from a housing market recovery, which we've had. And if we look, for example, on page 20, we show the recovery in home prices. So regardless of what index we look at, over on the left-hand side of the page, you see that home prices are picking up sharply. They're up 13% year over year for the recent data point that we have, which is October. They were up 12% the month before, 10% the month before. So my point is the home price recovery is actually accelerating. It is not a surprise because the housing affordability index is still at all-time low. So buying a house is as affordable as it's been in decades because interest rates are at record lows still, and home prices are well below their 2007 peaks. So as a result of that, the demand for housing is picking up. But if you look at the home inventories, the supply of homes, that is actually quite tight. We know there's been a big issue with overbuilding and excess inventories in 2006 and 2008, but look at how far they have come down now to about 2.3 million of homes available for sale, which is as low as we've had it going back to 1994. So the supply-demand equation is absolutely supportive for an ongoing recovery in housing. If home prices recover, delinquency rates on homes will absolutely fall. That helps banks. That, of course, helps provide credit to the economy. So the housing market recovery and the virtuous cycle that we think has started is absolutely key. One last thing. We've had a surge in residential construction. We have not yet had a material pickup in non-residential construction, but we think that is also to come in 2014. Commercial construction starts to catch up with residential.
Okay. Well, that is actually all of our questions. So I would like to thank both of you, Katie and Anastasia, who, by the way, Anastasia, you win the greatest name for anybody we've done a webinar with. That's an outstanding name. Yeah, that's great. I have a horrible name, so, you've definitely got me there. So I'd like to thank.
Not true.
Yeah, hopefully my mother's not listening to this. Thank you for braving the weather and going to the office and spending some time with us and giving us your outlook for the next year.
Our pleasure. Thank you so much for having us.
Okay. Thank you, everyone else, for joining us. Again, we'll bring the slide up for our firm as well. If there was a question that you had that didn't get asked, please just you can shoot us an email from our website there, and we'll, of course, pass it along. But thank you, everyone, for taking time out, and we'd like to wish everybody a Happy New Year.